Good morning. I am very pleased to be here today. And let me start by, again, thanking Hubert and the Africa Investors team for putting this event together, which is sponsored by IFC InfraVentures. And we have lots of expert project development, infrastructure specialists and executives here, and certainly have a very distinguished panel, and I'm very pleased to be moderating this panel. So what I propose to do is that I'm going to ask a kind of general question to the panelists, and after the first round of questions, we will go to the audience and get questions from the audience, and if there are no questions, I have a few follow-ups. But before I get to that, let me again say that I'm Alain Ebobisse. In my current capacity, I am the global head for IFC InfraVentures, which is the project development outfit of IFC and indeed the World Bank Group. We operate globally with two regions of focus, Sub-Saharan Africa and Asia. In Africa, we are very excited to be active in the project development arena in Sub-Saharan Africa. We've had a few successes, but also a number of challenges, and I'm sure we will discuss both successes and challenges today during this conference. One of the successes that I'm very proud of is the power project in Senegal that we have developed, helped finance, and now the project has achieved commercial operations. So we went through the full cycle of developing, financing, and building the power plant. The power plant is now delivering power to the population in Senegal. And in fact, the government is so happy that they've decided to award an additional project to the same team, and with an expansion of the power project. But we have also a number of challenges that we're facing. I think one of the projects that we are co-developing with Aldwych in Tanzania is one such project that is going through some challenges, and maybe Alain will talk about it. But project development is exciting, but also very challenging. So finally, I'm transitioning out from my role at IFC InfraVentures to take over Africa 50 as the Chief Executive Officer. This is an investment platform that is set up by a number of African governments and the African Development Bank. So another challenging assignment, but quite exciting, again, in the infrastructure space in Africa. Okay, enough about me. Let me now turn to the panel. And I think just one or two words before I get to the questions. Look, we all know that Africa has been facing some headwinds. I think you may have seen the latest estimates from the World Bank and the IMF in terms of the slower economic growth in Sub-Saharan Africa in 2015, talking about 3%, 3 to 3.5%. When in 2014 the growth was much higher, 4.5% plus. So we also seen a number of security concerns. So there are a number of headwinds. I'm going to take questions from the audience, but I'm going to throw a number out there and see how people react, because as an industry, of course, there is no one number that one size that fits all, but some ranges of what developers should expect to make. I think it's important that we communicate some of those principles so that lenders will not always be there fighting us back as developers. I've heard that for this project development business to be successful, one has to make, of course, the money back, plus maybe 1, 2, 3 times maximum, potentially, in terms of the development premium. So I want people to comment on that, to see whether this is outrageous or this is reasonable or not. And the development fee in terms of percentage of project cost, people are arguing 2 to 3%, maybe 4%. What is it that people actually feel comfortable putting forward without disclosing the actual negotiation that they have? Now, anybody in the panel can actually take that question, but let me also see if folks on the audience actually have questions. Otherwise, I have a couple of questions that I could actually continue to ask. All right, so let me ask this question on the developing premium. Anybody in the panel could take it. But also I'd like to ask a question on how to actually manage the lenders. Because many of you spoke about the difficulty of the financing process, especially on some of the large projects, but also for the small project. And I think, Brian, in one of your projects, QIPP, you very, very focused on reducing the number of lenders, and this probably is one of the lessons that you learned maybe from Azura. So let me ask the two questions. What is the appropriate range of development premiums, and then how to manage those lenders? Anybody in the audience, in the panel wants to take? Okay, Ellen, why don't you start?
We often are told that the metric is about 5% of total project cost for the developer fee. Now, several people have mentioned Azura, so I should probably refer to Azura, which is a 450 megawatt gas-fired power plant in Nigeria. It was the first of the new wave of IPPs in Nigeria. We hope that lots will follow. But it was a very, very tough project to bring to financial close with many challenges along the way. It's about an $880 million investment. So 5% of that is probably excessive. So then you're looking more at 2 to 3% in terms of what would be a justified fee on a very large project like that. People have talked about development risk, and because I'm a great believer in the open book approach and I'm not shy about numbers, what I will tell you, I don't think it's a huge secret, is that on that project, the legal fees alone were over $20 million. Now, project development is black and white. You either succeed or you fail. And if you fail, you've lost that $20 million. It's a lot of money.
Okay, that's fair enough. Okay, Brian, please. And then
sure. Yeah, I mean, because we're investing through the whole amount, we're investing Blackstone's money. We're not as focused on the development fees, but I think to the point of the number of lenders, really it's because of the cost and just the human nature of involvement of people. You know, to the extent you can minimize the number of people involved, you can minimize the fees and the common denominator factor and the like. You know, so QIPP is a more expensive project because it's a combined cycle, but it's 4 lenders as opposed to 17. And I think part of that was because of our position of having all the equity sorted so the lenders can come in at an earlier stage. But I think the real challenge and part of why it is so expensive is project finance is very linear. You know, certain work can't be done until other work has been done. And that puts all of the stakeholders in a difficult spot, because you really have to negotiate the PPA very early in the process to be able to ensure there's a project. You know, so from a shareholder perspective and a lender perspective, they should get involved. The flip of that is from the government's perspective, you're negotiating something where there's a lot of unknowns still. You know, EPC price, et cetera. You know, so it's very challenging from each side's perspective. You know, you're saying, hey, I need this document so that I can go and get the lenders involved and get the process rolling, because they really won't do their work until it is. But yet from the government side, they're looking for certain certainty on savings, and you haven't yet negotiated the EPC cost, because that's another $4 or $5 million of legal cost to get an EPC contract done, including the engineering, et cetera. So it is complicated, and I think in all of that, you know, the encouragement of the open book process, and going back to Mark's point about unsolicited versus solicited, you know, to how much work, how much risk can you take in the bid process if, you know, you're going to have to put a lot of fat into that bid process to sort of secure the unknowns, you know, from both sides. So, you know, I too am becoming more and more in favor of the open book process, because I think it's really difficult to lock down certain contracts for either side based on what you basically have two sides with opposing interests to protect.
Okay, thank you, Brian. So I think that Mark and also Ebe wanted to talk. And please, in the audience, I'll go back to you for one finalist. Mark, you want to make a comment on?
Yeah, on the same point. I'd like to say that development capital, I think, is the smartest money in the chain. We put as much effort in human resources than in cash. It's a lot of resources. And so the same way we separate the remuneration into the cash remuneration for the cash invested and the development effort, let's say. I think nobody is questioning a bank playing a role of lead arranger and charging 1%, 0.5%, whatever of the total debt raised. And they are not investing money for that. It's a pure remuneration of effort. So this is one side of the equation we put. The second side is the pure capital we put at risk. Equity fund, equity at closing is expecting 18% or in the range of, without putting any effort, just capital. So what is the cost of the same equity put at risk with absolutely no backing and nothing 3-4 years before? So if you take a 30-40% IRR, you compound over 6 years, you're going to find even maybe a 5x. So I'm just to be clear, we separate development effort, development fee, 1-2%, depending on the size, of course, of the project. A 1 billion project is not the same as a 40 million project. And the development capital we put. So this is how we solve this issue. And I think the ballpark figure is always the same, but when you skin the cat, when you slice it in different ways, somehow lenders can be a bit more, understanding. And it's come to a nice story. I was negotiating development fee with a lender recently. We had a 1.7x. So we put like 15 million and we had to get out around 12 million out of it. And the same lender acknowledged that they have a facility also, a development capital. And they asked 4x on it. But they didn't accept to pay our 1.7x. I said, but why? I said, because we are a DFI. So because we are a development institution, we are not dirty equity, we can charge that. And I come from an African Development Bank, by the way, so I am also a DFI guy. But just to tell you that it's also a perception of over-remuneration. And another point very important is when do we get this premium paid? Some people will ask us to get it only at end of construction. And as a developer, if I want to develop another project, I want to recycle my capital. How can I go and do a second project if my money is stuck during 4 years? Besides, I am handing over the board and the management, so how can I be at risk when somebody else is managing the project? So I think all these things, and I think developer community maybe also have not been, maybe we have not been enough, there is no coalition, there is no publication. All these numbers we're talking about, they don't exist. So maybe, case study, publishing, doing a bit of more, media about that, not being shy, putting case study, maybe can also help putting some standard. Because as we said, this room, I agree with Ebe. A few years ago, who was able to put development capital so early? 1 or 2 people, not so many. So today we have here a bunch of people who can put $5-10 million at risk to develop. But with that must come some standards. And I think with all these players, it is time maybe to establish a few standards. And we have not so many lenders. I mean, if you target the 10 biggest lenders of the continent and outside, I mean, that's it. The standard will be set.
Thank you, Mark. This is definitely something that we need to continue to push. I think I'm going to go to Ebe because you wanted to make a comment, and then I see a question from the audience there from you, Dan.
Okay, Mark, I'll join your developer union.
All right. Well, yeah, I mean, it's important.
Really, you basically said what I wanted to say, and I'll just repeat one thing. Looking at returns, it's not difficult to find roughly where the development fee, a sensible development fee should be. Sometimes it will be 1 time, sometimes it might be 2 times, sometimes it's less than 1 time of development cost. But it should be in the 30 range if the equity returns for the investor in the project taking construction risk is in the around 20. That would be my view. So
okay.
Whatever.
All right. Okay. Fair enough. Some would argue that it's even a higher return for that kind of money than 30, but that's a good reference point. Dan, I thought you had a question. Please come in. Any question from the audience? Maybe we start with Dan, and then we're going to start wrapping up.
Thank you, Alain. So my name's Dan Croft. I'm with IFC, but on the Transaction Advisory Services team, on the Public Sector Transaction Advisory Services. And I just want to come back to something that Sujoy mentioned in the opening presentation, these cross-country initiatives that can be developed. Okay, one of them was scaling solar, and it's been mentioned, and I'm leading the team in Zambia, and that mandate is moving forward. I have 2 linked questions for the panel. the thing about these programmatic approaches is, it's certainly in the case of scaling solar, it's designed to standardize everything, take all of the risk out, do a lot of the work up front, and then invite bidders to turn up and submit their prices. So my question to you, clearly from our perspective as a DFI, the idea is to increase the pipeline of bankable projects coming to market. Do you welcome the pipeline? I hope so. And do you think that a price worth paying is the fact that we're probably squeezing out quite a lot of the development premium that you'd like to be charging on projects? Because it eventually becomes a bit like the South African process, where it becomes, super competitive and tariffs go low. And what we found in the early stages of marketing was that some developers actually chose not to bid because they may have thought that they couldn't actually compete. So that's the first question. Specifically in the case of Zambia, we've tweaked the structure slightly so that the government forms the SPV, the project company. It does a lot of the development work, it starts the ESIA, it applies for permits, etc. And then it sells down 80% and it holds on to 20%. And the idea is eventually to do a range of projects and to IPO this interest that it's retaining to share the benefits with the local population. And again, that has resulted in Zambia in an incredibly fast process, which is presumably to be welcomed. But is it a price worth paying for the loss of 20% of equity and the hassle of then having the government in your shareholding structure? So do you welcome governments getting involved in development and taking a lot of this risk out, or would you really rather just do it yourselves?
It's a good question. Actually, Brian, and I'd like to hear from Henri as well. Brian first, please.
Sure. Yeah, maybe to answer the last part at first, having the government involved in some ways is welcome. But you use the word hassle, and it can be a hassle. In Nigeria, we have a parastatal involved in our investment, and I would say the team's quite a capable team. But when it comes to actually approvals and getting things executed, they don't have the same amount of swiftness as we do, and sometimes there's sort of parastatal issues between different agencies that we shouldn't have had to be part of, but now we've sort of sucked into the politics. And I think that's something that has to be well managed, because at the end of the day, it's slowing down the end objective of getting power into the country. So I think on the competitive nature, certainly South Africa was a very big success in some ways. And now I think the future rounds are a bit of a victim of the success, where it got so competitive that the deals weren't actually getting done sustainably in a way, and you've lost some rounds now because of it. But I think good on South Africa for getting the pricing they did, and ultimately, if you can strive for that, competition is great. Maybe not for us always, but that's reality, and from what I hear, the Zambian projects have attracted a lot of interest.
Henri, please.
Sure, and we did participate in the scaling solar tender bid, and we thought it to be very competitive. And as Brian is saying, hats off to government that can sort of do those processes. They're not easy to do, and I think in this case, IFC and various advisors brought a lot to the table to make that happen. It's not easy. There are some issues with respect to the site and the sinkholes and things like that now it's toing and froing as to who takes that risk. But I think at the end of the day, when you run a competitive tender process such as that, you probably get the best results. So solar in and of itself is probably leads itself to that. I think once you get into more complex technologies such as combined cycle, it becomes a bit more difficult. And the thing I fear is when you get into a much more complex environment, than the ability for the counterparty, principally the government, maybe the government in the broad sense, the off-taker, the government partners, and all those sorts of things, their ability to kind of understand sort of the ins and outs of that become very challenging for various reasons. So I think it's good for the country, and I think if it can be accomplished, great. I don't necessarily see it as a silver bullet, so to speak. I think in solar, certainly it's a very attractive and interesting place to be. The question about is it attractive to developers? I think to certain developers it is. I think it's going to be very attractive to some key developers on the continent who very much are just focused about pushing panels out or getting EPC contracts and look at the supply chain across the board and trying to be the most competitive. That said, I think it's still early days. As I mentioned earlier, you know, we have a number of power plants around the continent, and very few of them get paid on time at this moment, and things are getting worse. So, so the success of scaling solar, I think, can be a very successful program, and I think it can accomplish its job, but there's a lot of parameters that I think people probably post that are going to struggle with, and some of the challenges, you know, we'll have to deal with when we get there. So.
Okay, thank you, Henri. Actually, I was quite interested in what you said, that this kind of approaches are more attractive to certain kind of developers, and you included solar panel manufacturers that are trying to push their panels that indeed can make a competitive offer. Do you see that as a good thing, or I mean, are they proper developers, or what's your sense?
Yeah, I mean, I see it as a good thing. I see it as taking it, you know, countries should take advantage of the parameters, the market conditions, and things of that nature. Is it good for guys like me or Brian? Probably not, but that's fine. We just have to go to places where our strengths are brought to bear. And I think in Brian's case, it's large, complex projects. In our case, it's combined cycle plants. You know, when the sun stops shining, you'll give us a call.
Okay. Hélène, please.
Thank you. Dan asked whether developers, in principle, would be willing to take a lower return because a lot of the risk is taken out of the project. And for the avoidance of doubt, I don't think any developer is in this business in order to make a premium on the high risk money that they've put at risk. So if we never had to spend a penny on development, we would be very, very happy indeed. But otherwise, I agree with what Henry said. It's horses for courses. What has been proposed in Zambia and I believe in Egypt and other places relies in part on having a good baseload power system to back up the solar, because you can't just throw a whole load of solar panels onto a grid that is too weak to take them. Like Henry, like Brian, we go for things that are more difficult. We closed Lake Turkana, the 310 megawatt wind farm in northern Kenya in December 2014. If that project had been bid, everybody would have laughed. Indeed, when I first saw it, I laughed. It seemed a totally illogical thing to do, 310 megawatts, 400 kilometers from the load center. So that's not something that could ever have been bid out. So it depends on what you need. And right now in the African continent, we need everything.
Yeah, I do believe that we need different approaches, certainly. So we have a question here, and then we're going to start to wrap up. I don't know how much time I have. Hey, Raymond, you just joined. 5 more minutes. Okay, so a question here from Kofi, please.
Yes, thank you, Alain. Kofi Clousset from IFC InfraVentures. My question to the panelists is with regards to engagement with governments. Project developers have as first client governments, and it is really critical to see how a government's behavior impact the business. Project award, you mentioned it, Mark and Brian. What type of project award? If the project award is not clear, the process is not clear, very quickly you run into problems trying to fix it. Planning, how are projects selected by the government to be provided for private sector development? That's another question. If that process also is not clear, all the projects are competing against each other, and project developers get pitted against each other. Very bad allocation of resources. And finally, with regards to government, is what happens to the organizations that used to do these things before? They've been displaced by private sector intervention and are creating resistance in the system. And often you get them through the back door, basically making it difficult for projects. So my question to you is, what, in your view, is critical when you discuss with government to obtain and to get in order to get a project to be successful?
Good question, Kofi, and anybody really in the panel, Mark, you could start. When do you get comfortable starting to spend that money?
Yeah, for me, everything starts with, does the project make sense for the country? So some people were very happy to get 20 cents solar PPA 2 years ago, and now they have been asked to renegotiate. So you just have to make sure it makes sense. I think with the World Bank Group and AFDB and all of that, you can find in almost all countries some demand-supply analysis or energy master plan. I mean, you have a base to know more or less in each country what is more or less needed. So you even have all the PIDA priority project, I mean the ECOWAS project. Wherever you are, I think you have a base to see what kind of technology or what kind of tariff, is it a base load, peak load? You have this kind of view, oil import or not, etc. So the let's say technical, strategic analysis is the first thing. Does it make sense for the country? Then you can start to discuss. Then yes, I think you always have this, that's why I was saying before, I think the open book is probably the only thing that will really work at the end of the day if you are going through a direct negotiation. And I think everybody is doing that. Even DFIs go and do direct negotiation sometime on their project. But it has to be open book. Otherwise, government will change, it will question you. Minister will change, it will question you. So I think the best thing is just to be open book, to build the EPC so nobody has a doubt on the biggest item of the CapEx. And then the rest, you can be transparent on your interest rate as well. Actually, I did negotiate, and we are developing, now we are in the EPC bidding in Côte d'Ivoire for 44 megawatt hydro, and this is the way we did. We agreed with the government, with the utility, we sit down, we open the financial model, we agree on the IRR, we agree on the bidding, and now we are just developing it in a transparent manner.
So that's very nice, but then you're an EPC contractor sitting next to you that when they get involved in project development, I suspect they want to have the EPC contract. So how do you square that potential conflict?
In that case, you cannot take a technical partner. I think this is also a hard thing. Very often, the turbine manufacturer or the EPC contractor is keen to come, but this is where project developer has to be very clear on their model. I mean, if you want a kind of bid, yes, you can partner with whoever you want. But if you are negotiating on a direct agreement basis, I think it's quite tough to partner early on with your EPC. So it really depends on the model. But in that case, in Côte d'Ivoire, it's just impossible.
Fair enough. I understand. I was lucky. I was trying to put you on the spot. But,
Thank you. I think for us, as I mentioned maybe briefly earlier, you know, when to pursue these projects and at the development cost that goes with them, we really want to make sure the government's committed. So normally you can get that quite clear. But if there's not a champion appointed by the government that takes you through the process and that will help you drive that whole process, I think in principle we will not proceed with that, because to go through all the departments, all the legal stuff, and we maybe not set up like a big development guy, but in principle you need that guy to drive it. If we don't have a guy like that to drive it, it just is a black hole for us at the end of the day, and we'd rather not proceed with the project.
Okay, that's very true. You need a champion, but sometimes the champion got moved and then things get stalled. But, you know, that's life. Anybody? Look, I'd like to start to get closing comment.
Can I just ask you a question?
Yes, please, Barbara. You have the right to...
In talking to some providers of insurance, both public and private sector, if they were here, I think they would say, what about our instruments to cover project development risk? For example, breach of contract. Do you see this of value or not? And how, if so?
Okay, anybody? Brian, want to talk about it?
Look, I think as the projects get more, I mean, the project we're working on in Nigeria, I can say we've had almost 6 to 8 weeks of holdup over insurance gaps. You know, so it's a gas provider where the power plant, you know, what happens if there's a total loss of the gas providing and our entity's fine? You know, we can't call insurance on our entity. So we have to effectively get a third supply total loss, you know, which is complicated. So we had to go out to market makers, et cetera. You know, I think the insurance market is pretty sophisticated, but it becomes expensive when there's not a market and you have to make it. We've had similar discussions on early stage called political risk insurance, if you will, with OPIC, so effectively covering a breach of contract. And while we've looked at it and had plans to enter into it, typically, once you get into those contracts, it's very hard to breach except for expropriation between now and construction. You know, if I sign a PPA with NBET in Nigeria, what could they do to breach it, you know, between now and actual financial close? You know, they only start paying at COD. You know, so it truly, I mean, development comes back, it is venture capital money. You know, you're spending money purely at risk on a binary solution. You either build the project or you don't. You know, but, you know, I think, as a bunch of people have stated, you know, these issues are becoming more and more known by both sides of the party, you know, and the market's becoming more sophisticated towards it. But there's no panacea here. I mean, it's really a long haul.
Okay, thank you. Look, let me maybe get started on the closing comments because I see there is no more question. Oh, okay, please. I think we have time to one question before closing. I'm looking at my, I don't know who's the timekeeper, probably it's me, but.
Thank you very much. My name is Longer from MBAT. I heard the panelists talk about they prefer the open book. I think they do that because they're on this side of the table. Now, from the off-taker side or from the government side, we really want the best tariff. So where you have standardized document, everything set, it makes more sense when you go for the competitive. That helps you to bring down the tariff. But trying to stick to saying is open book, I don't think that will help us to have a very viable project that will not have problems in the long run.
Okay, so that's the view from the government side. NBET, biggest off-taker really in the continent, one of the biggest certainly. So they are not thrilled about this open book policy that you guys were advocating, but Brian, go ahead. And well, quite a bit of reaction here.
No, look, I think, I mean, Longue and I've had a lot of these discussions. It's an interesting discussion, and Longue's boss said to me at one point, you know, Brian, I don't want to know your business. You know, I need to know my business. I mean, when you get into open book, the reality is, you know, there's a million ways to look at things. You know, this level detail, this level detail, this level detail. You know, and I'm a very numbers-oriented guy, so I was fighting these guys. No, use my model, use this, use that. You know, and the comment back was that doesn't help me. What I want is tariff. I don't know why I'm more comfortable that I'm going to get there with your model than some other way. And I think that's, you know, I had to sort of step back and say, okay, I hear your perspective. So I think that's part of the process of the market. Right, you know, the first round's going to generate this tariff, and the second round's going to generate that tariff, and the third round. You know, and I think that's why South Africa is a very interesting example. You know, it's all these successive tariffs getting more and more negotiated, and people yet were still showing up and knocking on the door. You know, maybe I didn't show up at that last round or that someone, but someone did. You know, so yeah, I had a lesson learned in going through that with NBET that I was emphatic that my way was the best way. But I could appreciate why they had a different perspective on it. And then the challenge that we have is, okay, well, how much risk can I take at what I know right now? You know, the answer may be, I can get there or I can't get there. You know, but that's part of the negotiation that we have to go through.
Okay. Ellen, you have some perspective on that?
Sure, I feel utterly challenged. No, it's not the case at all. In fact, what we're seeing quite often is that with international competitive tendering, the tender rules are so detailed that in practice you are breaking down the tariff quite extensively and showing what your development costs are, what your non-EPC costs are. So it does go into quite a lot of detail, even if it's a public tender. But I think also in some places, and Nigeria I suspect is probably not one of them, it's helpful for the government to be able to say in Parliament, when questioned to the press, I know what makes up this tariff because I've been part of that discussion. Not everybody wants or needs that, but where they do want or need it, it's very helpful for us to be able to be part of that and agree what the parameters are.
Okay, so my own view is that tendering is probably the best approach to procure this project under a certain number of conditions. When the regulatory framework is still untested, you have some of the first projects in the country. It's not always easy to have a tender process that will go very smooth. But we are all shooting towards having enough standardization, enough track record that eventually the tender process will be the way to go, I think. But I understand the dynamic between the governments and then developers, and that's why we're here to discuss. Loki, please go ahead, and maybe you can make also your concluding remark at the same time, please.
Yes, I'd just like to comment on that. I think that for government to get competitive EPC tenders, they need to make sure that maybe there's potentially a pre-qualification process so that you're competing against 3 or 5 other competitors. That'll ensure that the guys put in a lot more effort to get a competitive price than when they're competing against 20, 30 people out there to spend that type of money with such a low chance of success, in those bids. So somewhere there's a balance there, and that's all I'd like to add there, that I think there should be a process where you pre-qualify, and therefore you know that you're only one of 3 or one of 5, and then you put in a real effort, and you'd be able to spend more money on the bid. That would be my opinion.
Okay, thank you. Henry, you wanted to come in? I saw your mic open.
Yeah, I think, it's a kind of an interesting idea, this balance. And if I go back to how the IPP industry started in the U.S., quite frankly, is that, and this is in the 80s, that U.S. utilities had a very different procurement and construction process. And they effectively were the high-cost provider. And because of that, the U.S. government basically sort of said, okay, create the IPP laws and said, okay, you can beat the host utilities, then the host utilities has to buy power from you. And I think we're kind of, it's that balance between, okay, if you do it right, yeah, you can come up with a very low cost of power, but when you look at the evidence that's currently on the continent, there's such a lack of power, and there's a lot of issues that sort of go around that is fundamental to that. Trying to just sort of look for that one solution sometimes is very difficult, and I think that's where you kind of get into this open table bargaining around, okay, I need power, what can I do, what can you do, what do I need, that sort of thing. So I think that's kind of where we are right now in the more complicated areas. I think in solar, you might be able to do that with scaling solar program, things like that. So anyways, just my 2 cents.
Okay. Ebe, can you say
just
something?
very quickly, I think both when you have negotiated processes and when you have going into tender processes, as a developer, you want to be treated fairly in a fair business way. And so to go through a long process with a government, and then they basically come up with new requirements and say, we're going to tender this, that is not great. And it happens sometimes.
Yeah, it does.
And the same actually with when you have a lot of negotiated deals, like in some countries, I think Ghana would be an example today, where there are a lot of deals. It's not fair actually to the developers that are there, because they come in and they actually all believe they're going to close their deal, and obviously they're not.
Yeah.
And so I think there is a responsibility on the government side to create some kind of order, even in the negotiated deal processes.
So I suppose we're talking predictability. Everybody wants a bit more predictability on both sides. One of the things that, frankly, also I've observed in looking at those projects being negotiated is that the parties don't give enough value to the time it takes to actually to get those projects done, in the sense that sometimes they want to negotiate for reduce the tariff by half a cent, and it takes a year or 2, and they don't see the cost, the huge cost to the economy of delaying that project by a year, which is maybe 3, 4, 5, maybe 10 times the gain that they're trying to get in the negotiation process. Now, I understand from the government side, they're subject to scrutiny, so they want to get the best deal, but there's so much shortage of infrastructure, and I think that sometimes on both sides people have to be pragmatic and just get the deals done. That would be my kind of suggestion. Now, closing comment, because I think we are exceeding. So let's do this quickly. I guess I will start with the other side of the table, just to be unpredictable. Ebe, you want to say a few closing comments just to finish up? See, I was unpredictable, so Ebe.
You put me on the spot there. Yes. Well, look, we're developers. We're looking optimistically at the continent, and it's exciting. I think for all of us sitting here, we have to both do development and do good business, but I think it's really important that there are real African developers coming up. There's a lot of capital and a lot of know-how coming from outside the continent now, and that's really what's going to make a huge difference going forward, I think. So I hope that that's where the process is going.
Okay, thank you. Henri?
Look, it's a really hard job, and it's very difficult. It's very painful, and it's not going to. And in the short term, I don't see it getting any less painful and difficult. But I do see a recognition of it here through this process of what it means and what it takes, and I think making sure there's an understanding and a dialogue around that with a lot of different entities, lenders, government officials, and things like that of that nature, and really going back to why does the IPP exist? Why are we here? We're here because the other system, whatever is there, hasn't built the power plants that are needed to be here, and that's why we're here. And so I think we got to just kind of figure out how to make it work. It's a very difficult sort of environment.
Thank you. Okay.
I just think from our point of view, I mean, we, in a way, developers by default, coming up the chain, from the construction side. So although I said in my opening remark that these things have a long cycle, there certainly is some projects out there on the energy and the transport side that we're looking at from Ghana, Ethiopia, Tanzania, Kenya. And so there are real projects. I think people are going to be extremely selective of where they spend their resources and their time into the future. But it's positive to hear from the IFC side, that they are intervening at government level, de-risking some of these projects to a large extent, which will make the appetite bigger, I think, from our side.
Thank you. Mark, please.
No, I would say that I think private sector understood that project development is key. I mean, ourselves, Abraj, New in Energy, we are bringing 15 people and dozens of $1 million for this, but we need structure. And I think I will throw it back to you maybe, because I really think that even more now, Africa 50, AFDB, IFC, this kind of institution can help putting a framework, even on the government side, being a fair broker in this process. So I really think that engaging a bit more maybe with this large institution are key to create a bit of framework around that.
Good. Brian, please.
Yeah, I think these project finance deals are, it's a bit like Groundhog's Day. You run into the same problems over and over again. And I think one area that hasn't changed and hasn't modernized that much is the project finance side itself, the lenders themselves. And I think there needs to be some review on the risk that they're willing to take and get into. The default structures, the cross default structures, this is where the days turn into months and months turn into years. And if countries are going to scale and do multiple projects at once, I think the lenders also have to start looking at taking on more risk and where they can step in and be more DFI-ish.
Mm-hmm. That's an interesting point, which I may have a different perspective now that I'm moving to a different job, but Alain, please.
Thank you, Alain. It's been an interesting session. We could, of course, because it's all our passion, we could go on for hours and hours and hours, and you'd be relieved to know we're not going to. I think sometimes we get so enmeshed in the problems, which are considerable, of financing these projects, of project finance, of the tariff, getting the right tariff, of the costs, what are the returns. Sometimes we lose sight of the bigger picture, which is that we are also providing a social good. And we need to remember that. We need to remember that what we do in Nigeria, in Ghana, a case in point at the moment, we've got a problem in Ghana. And we know that by solving that problem, we're going to make the sector sustainable going forward. So however difficult it is and frustrating and costly to see that delay while we fix that problem, ultimately it's for the benefit of all. There's a lot of talk nowadays about impact investing. It's one of the new buzzwords. And it's true, we have an impact and we have to be conscious of that. So we need to structure our projects to make sure that they are beneficial to all parties.
Thank you, Alain. Thank you very much thank you to the panelists. I think it was a lively discussion. On my side, really quickly, I think, we talk about many challenges, and indeed there are many challenges, but there are actually a number of deals that are getting done, so we need to see a bit more deals. But when I see what has happened in other regions, emerging regions, certainly in Latin America, but even in, you take a country like Pakistan, where things are really messy in terms of the sector, but they get deals done. They get a lot of deals done. So I think in Africa now we are reaching a kind of tipping point, in my opinion, where more deals will be done. But I think I particularly like the fact that the project development community is actually getting their voice heard, because we need developers to come in and help build more bankable projects. Okay, thank you very much to the panelists. Let's give them a round of applause.
Doing business in Africa. You can't afford to be without Africa Investor.